It's a great day in North Carolina. A little rain out there, but really hot, I'll tell you that.
Absolutely. And today's topic, how to protect your legacy and pass wealth to your family tax free. So it's really, really important. Why is it essential to plan for passing wealth tax free? And what common mistakes do families make?
Well, Neil, as I always say, you've got to have a plan and you have to approve on it every year. If you don't have a plan, start one, but you've got to have a plan, whether it's your marriage, your estate, college, or whatever. But it's essential because without strategic planning, estate and inheritance taxes will significantly diminish the value of your legacy. The biggest mistake I see families is assuming traditional estate planning methods, such as a basic will or standard retirement accounts, provide adequate protection. And unfortunately, this leaves beneficiaries facing unexpected taxes, probate fees, and significantly reducing their inheritance.
And that's a problem for sure. Can you explain how life insurance can effectively be used as a legacy building and wealth transfer tool?
Well, Neil, I've always said cash value life insurance, whether it's index life or properly constructed whole life policy, is probably one of the greatest financial vehicles out there. But properly constructed cash value life insurance can offer substantial tax savings through IRA codes 7702 and 70E. Products like Index Universal Life, which I have 5, or whole life policies, which I have 3, allow wealth to grow tax deferred and pass to the heirs completely tax free, and it does not affect the taxation of Social Security or the means testing for Medicare Part B, which will be in the thousands, Neil. They can also provide liquidity to pay estate taxes, debts, or provide ongoing income, ensuring your family receives your full legacy without burdens.
And that's huge because
Well, Neil, here's another thing. I just had a client recently. He's a very wealthy man, and I've made tens of millions of dollars of tax-free money for his family. That's not just for his kids and his grandkids, but this will last for generations if properly handled.
yeah, and that's the key. And that's why contacting someone like you, Alan, is so important. What are some overlooked tax pitfalls in traditional estate planning?
Well, a common overlooked pitfall is relying too heavily on taxable retirement accounts like IRAs or 401ks, which create a significant tax burden. Do you realize, Neil, that the taxes in these, like I've always said, a 1% fee in a 401k will reduce your income by 1/3 of a 30-year period. The average fee in a 401k is 2.99%, and that's by Forbes magazine and Lap Times. People are going to be left with half of their money, and then they get hit with taxes, anywhere from 20 to 55%. Other things that people don't understand, because of the Secure Act that passed a couple of years ago, they can't pass these retirement accounts like an IRA or 401k on to anybody except their spouse or a disabled person. That money has to be spent by the beneficiaries within a 10-year period and taxed at their tax rate. Another pitfall is inadequate use of trust structures. Now, I can't tell you how many trusts are out there, but without proper planning, your real estate can face heavy probate fees, estate taxes, and creditor claims, eroding your legacy considerably. But understand this, Neil, you remember Prince the Entertainer that died a couple of years ago, correct?
Right. Yes.
And I've said this before. He had no plan. He had no will, no proper trust set up. And when he passed away, he was a young guy. But his family would probably get maybe 20, 25% of that estate, because what the government does, it puts it in probate. And what I call probate, it's a lawsuit that's initiated by you that you're going to pay for and you're going to lose. Because what they do is they liquidate the assets and sell them to pay the taxes on the estate. And what's really bad, attorneys get 6 to 12% of that estate for legal fees.
Yeah. And that's crazy, right?
Yeah.
And so, I mean, so many ways, it's like, really? Are you kidding me? And it's like you're falling for it in so many ways, uh, falling for it. So how do Roth or IRA conversions fit into legacy planning?
Well, Roth conversions strategically shift taxable retirement savings into tax-free growth vehicles. And people do not understand the importance of having a tax-free vehicle. After paying taxes once during conversion, your wealth grows grows and transfers tax free. And I'll give you a perfect example. I had a gentleman, a multimillionaire. He was 65 years of age. He's got $1 million in this one IRA. He didn't need it. I said, what are you going to do with that? He said, well, I'm going to will it to my grandson. I said, you can't do that. He said, what are you talking about? Well, I said, first off, I think I made him mad. But I said, whose is that? He said, well, it's mine now. And there's my name right there at the top of the account statement. And I told him, yeah, but you got a partner. It's called Uncle Sam, and you're in the 40% tax bracket. So you got $600,000 right now. And man, I didn't realize that. And I said, that's just federal. That's not state or AMT or anything else. I said, what about your required minimum distributions, the RDMs or RMDs? He says, well, what's that? He's 65, deal, and his financial planners have never told him about it. And they're supposed to be fiduciaries. I said, at this time, this was back in 2017. I said, if you don't take the required amount of money that the government tells you from your qualified plans, IRA, 401k, or anything like that, it is a 50% penalty plus all the taxes. You'll have less than 4% of your money. Oh, you look like deer in the headlights. You know, well, Alan, what are we going to do? I said, we're going to pay taxes on it. Why? I don't want to pay tax. I said, buddy, nobody wants to pay taxes. But what we did for the next 5 years was pay taxes on, we withdrew $200,000. The last year we either withdrew less or more, depending on what the market did, paid the taxes on it. Now I told him, I said, by 70 now, there's no required minimum distribution because it's a Roth IRA. Now think about this. It will grow tax deferred for your lifetime, tax deferred for your son's lifetime. And when your grandson gets it, you're going to have millions of dollars of tax-free money that, again, does not affect the taxation, Social Security, the means testing, Medicare Part B, plus many other benefits. You just created a legacy for your family with this one move. And obviously we did it.
Right. Are there specific financial products or strategies you recommend most frequently for tax-free legacy planning?
Well, the number one thing that I recommend is cash value life insurance. I don't think there's a better financial vehicle out there. It grows tax deferred. You get your money tax free. It's protected from lawsuits, liens, and judgments. And here's something that people just don't understand. It helps to mitigate the cost of long-term care, which is between $50,000 to $200,000 a year, and that with tax-free money for pennies on the dollar. You buy a life insurance policy for, say, you got a $100,000 death benefit, you may be paying, I don't know, $100 a month or something like that. But what you're doing is you're paying for protection for pennies on the dollar to help you to mitigate one of the risks in retirement. The other thing the cash value life insurance does, it eliminates the risk in retirement that a stock portfolio, bond portfolio, money market funds, CDs only compound. Remember, Neil, it's not about rate of return in retirement. It's about distribution of your assets. Now, these cash value life insurance policies eliminate or reduce estate taxes and often considerably protect against, well, it protects against market volatility because it eliminates it. It eliminates creditor claims. You're protected from lawsuits, liens, and judgments. Like I said, this is one of the greatest financial vehicles that's available to people, and they don't know about it.
And they truly don't, and it's sad because they're not hearing from it in so many ways. What role does asset allocation play in effective legacy protection?
Well, asset allocation is very crucial. Can't even talk today, because diversifying assets strategically into tax advantage and protected vehicles ensures your legacy survives unexpected market fluctuations, economic downturns, and tax changes. Balancing assets between growth-oriented and stable tax-free investments helps preserve wealth over generations. Now, Neil, this is what I tell people. I said, you've got to have diversified assets. I'm not against the stock portfolio, although I'm very conservative. But here's the thing. When people tell me, well, I'm diversified in my stock portfolio. No, you're not. When the market goes down, everything goes down. You may have one or two stocks if you were lucky enough to get the right stock that will go up. But let me tell you what, 2008, ask those people where they lost 38 to 52% of their retirement.
Right. They weren't very happy, were they?
No.
And so that's the process for sure. Okay. How soon should someone start planning to pass wealth tax free?
Not soon enough. The best time is now. Tax-free legacy benefits from compounding growth, meaning the sooner you start, the more you maximize tax advantages and wealth accumulation. And understand this too. The younger you are, the more healthy you are. So that makes a big difference when it comes to cash value life insurance. Excuse me. Early planning also allows greater flexibility and effectiveness in adjusting to tax laws and personal circumstances because they all change and they change every day, every year, Neil. And that's why I tell people you've got to have a plan and you have to review it every year.
What are some real life examples or client success stories illustrating these strategies? You've talked a little bit about that on earlier in this podcast.
Well, like I said, yeah, I recently worked with a business owner facing a potential seven-figure tax bill upon transferring his business and retirement accounts. And one of the things I tell business owners, I said, how would you like to get a tax deduction instead of paying capital gains tax when you sell your business? Well, Alan, I want that. How do you do that? I said, it's not how I do it. It's how the people that I know that know how to do it. These are part of my team members. They're specialists in their fields, tax specific attorneys and CPAs and other specialists in the fields. And we know how to do these strategies. We implement a irrevocable trust combined with an index universal life policy. The structure entirely eliminated future estate taxes, reduces current income tax burden, and ensured his family receives a multi-million-dollar legacy tax-free. This can be done, but it's got to be done with planning, Neil.
Right. And if you don't plan, you're in trouble. That's why you got to go contact you today by going where to strategicwealthstrategies.com or email you at strategicwealth, the number 0 at gmail.com or call you at 910-551-1046. Correct?
Let me tell you, yeah, exactly right, Neil. Let me tell everybody out there, I don't charge a fee for my services. I want to educate people on the financial strategies that the wealthy and people that know the taxes and the banks have been using against us for years.
All right. That